So it looks like we're slowing down. Whoa, got ahead of me. So I was going to say, let's dive into it. And as we have more people come on, they could jump on. Um, just that you do know, and I will mention this again in the presentation, we are recording the presentation for others. It will also be translated into Spanish. So if you do want that link, we will be putting it out on our social media. You're also welcome to email us and we can get that to you. So my name's Gary Romano. I am the founder and chief strategy advisor for Civitas Strategies. We are an organization that works with childcare providers around the nation. Um, and tonight we want to talk about HR1, also known as One Big Beautiful Bill. Um, in particular, tonight we're really going to focus on what the implications are for childcare business owners and coaches as well. So if you are a childcare business owner, if you're somebody who supports them, that's the focus this evening. I know there's a lot in this bill, a whole lot. And so we're just being very narrow in our focus about things that directly affect those childcare businesses in particular. Um, we should note that the guidance is evolving. There's a number of places where we are still waiting for what they call rules making, which is, as you can imagine, where they make the rules, right? So as that information comes in, we'll certainly be sharing it on social media, on other lists that we have. If you're on our newsletter, you can see it there as well. Um, and so we will certainly share as we know more about it. But we want to make sure you at least started preparing for it because this is one of the largest tax and spending bills our nation has seen in many years. And these changes are rolling out with different impacts. We're going to talk about when those impacts hit us, but they've literally already started and will be continuing through 2026 and beyond. But we're going to start seeing the initial things. I mean, the initial things have already been signed. On signing, they happened. So back in July, they started, whether you're ready or not. But we're going to see a whole lot more things hitting soon. And again, there's many that are still in rules making. And so I will point that out if you have questions along the way where we know things versus we're not sure. So what are the changes we're going to talk about tonight? Initially, 2025, we're going to talk about depreciation because there are some changes to depreciation. There's changes to the 1099K. You will not be quizzed on that. I will explain what it is. So if you're not sure, don't worry. There will not be a written exam on it. The child tax credit and also deductions are changing. 2026, we're going to see a number of other items come online, right? So this starts literally January 1. So just a few months from now, we're going to see the child dependent care credit have some changes. We're going to see 45F. I'll explain what that is. Again, you won't be tested on any of the tax code that we're citing here tonight. 1099, there are some changes there. You're going to see the child investment savings plan come out. There are some immigration changes that we want to make sure that you're aware of for you as well as your families or the families you serve. Student loans are going to have some changes, as well as we're going to see a bunch of changes to Medicaid. Finally, 2027, we're going to see some changes with SNAP eligibility. So I'm going to go into all of these. I just wanted to give you a sense of the big picture. Along the way, if you have questions, don't hesitate to throw them into the chat. And certainly when I'm done, I could open up and answer any questions that you have. But I thought I would just keep us going in the meantime. So depreciation. And for those of you who have been with presentations with me before, I love depreciation because when it's done right, it can mean a lot of money for a childcare business owner. When it's done wrong, it can be very impactful in a very negative way. And so what we're seeing, and this is one of those things where we talk about things that have kicked in already, this is something that has kicked in already. Bonus depreciation is back. So there's a full 100% bonus depreciation and it is now permanent. For those of you who were aware of bonus depreciation, And certainly, I'm going to give you, by the way, some resources at the end of this. And one of those things is going to be pointing you to our website where we have a bunch of free resources. Um, so you can learn more about depreciation ad nauseum if you so choose. There, so I won't go deep into what depreciation is, but put simply, when you buy something that is a larger purchase for your business, you typically have to depreciate it, which means you have to take the deduction over time off your business. That could be a real big problem because if, let's say, you buy a $10,000 item and the $10,000 has left your bank account, but you can only deduct $2,000, well, that means you're going to have a bigger tax liability this year. Now, next year, the year after that, the year after that, it might be lower, right? Because you get to do the rest of the depreciation. But that first year, it's going to hurt. The second year, it's going to hurt. So, what with depreciation, especially if you're a small business or you're a micro business, like a family care provider or a center with like fewer than, let's say, 25, 30 employees, depreciation could be a big problem for your cash flow, especially because very often people aren't aware of it until they go to get their taxes done. So bonus depreciation means that you can deduct off your taxes the same year that you spent the money. So that's a good thing, right? It just makes it a lot easier, especially again, if you're small. For what we were seeing in the pandemic, we had bonus depreciation and slowly it was going away. It was supposed to go away in 2026 and it was being reduced, but now it's back up to 100%. So it's full bonus depreciation on anything put into service after January 19th of this year. So that's going to let you write it off in 1 year again to make it easier. Section 179, which is another type of depreciation, I'm going to talk a little bit more about these in a minute. That's going to more than double. So now, if let's say you're working with or you have a larger center, maybe multiple sites, this is something that you may have touched on in the past, and so it's going up from 1.25 million to 2.5 million. So again, this is a big move, and this is for pretty much anything you put in service this year, right? That would qualify, right? Just thinking about the timing of it. So, what are some of the things that are affected by this? So first of all, it's most what they call tangible business property with a 20-year or shorter recovery period. That's a big way of saying a lot of the things on this list. It's playground equipment, it's appliances, it's furniture, it's computers, tablets, educational technology, security cameras, HVAC systems, and major mechanical improvements. So these are both affecting you if you are a home-based childcare business or if you are one that has a facility. Vehicles for transporting children get depreciated in this way. Flooring, fencing, safety improvements, educational materials, classroom supplies, all of those major expenses that fit into these categories can be subject to depreciation. Now, what we see is between the two of these, you're going to end up with a great deal of flexibility because each one covers some of the same things, but they also cover some different things. So with Section 179, you're allowed to use used or pre-owned equipment. With bonus depreciation, only new equipment. So this gives you some options for your business. With Section 179, it can be used 50 to 99% for business. Of course, you want to deduct just the business use percentage, right? You can, allows you to control the exact deduction amount if you wanted to. So if you didn't want to do 100%, you don't have to. Whereas with bonus depreciation, it's all or nothing, right? And Section 179 cannot create a business loss. So what does that mean? So let's say with depreciation, you made some big investments, you're actually going to be spending more than you took in revenue. Well, with Section 179, you can't deduct it any further than your revenue, right? Whereas with bonus depreciation, it can create a business loss. So if you actually lost money this year, maybe you're starting up, you invested in a lot of equipment, you invested in facilities, right? You can actually run at a loss in that case. And so um, the bonus depreciation part of it, again, gives you greater flexibility. It also covers some interior building improvements, such as new sinks, toilets, interior doors, interior walls, lighting. It also allows you, bonus depreciation can kick in when you start exceeding thresholds for Section 179. So I know I just threw a lot of words at you. Um, what I want you to take away most from this are two things. One is that you're going to have greater flexibility. And the second thing is you are much less likely to end up in a situation like many childcare providers did during the pandemic, where they would get a grant, they would get an investment that they made in their facility, in their home, and then find out through depreciation they're going to be hit with a big expense this year. We're also seeing some changes to 1099K. Now, I promised you weren't going to be quizzed on any of these, and you will not. So 1099s are a whole series of forms. We're going to talk a little bit later about another one that's changing next year. But a 1099 is essentially a form where you report revenue where you report a payment to somebody where they haven't been paid for it as an employee, right? And so this is a way that the government can track these transfer funds that are not employee income. The 1099K tracks payments that are made through apps, such as Venmo, Cash App, PayPal. Um, Many providers, especially the smallest providers, often use this as an electronic payment alternative for their families. So this is something that does come up. In the past, you didn't get the form unless it was 20,000 or more than 200 transactions that were made, right? So if you had $10,000 of payments from parents on Cash App, you didn't get one of these forms. It was starting to move down to $600. And so this was going to create some new paperwork for providers. Certainly, if you think about the multiple payment apps that providers are sometimes accepting, this could be multiple pieces of paper that they're now tracking. What ended up happening was with HR1, we're now just going back up to 20,000 or 200 transactions. So the big thing here to know is that you're not going to get this other form, chances are, at the end of the year. Now, some of you may, because maybe you break those two levels because you're very much into cash payment apps, you're a larger business, or you're working with a larger business. But for many of you, this is just going to be one less piece of paper you're getting at the end of the year. I do want to remind you, though, that even if you don't get a 1099K, you do still need to report the income. So we now are talking about some credits. And before we get into tax credits, I want to go deep into some of the tax concepts, but I do want to make sure that there's at least some understanding of why we're talking about tax credits a fair amount in this presentation. And that's because they're magical. That's what I like to say, right? They help a business a lot more than a deduction. So what happens is a tax deduction reduces the amount of income you're taxed on. A tax credit reduces the actual amount of the tax you owe dollar for dollar. So they tend to be more valuable. So what does that mean, right? I'll give you an example. If, let's say, I'm at the 22% marginal tax rate, so we have a graduated tax system. Every dollar I add, my top tax rate is 22%. I get a $100 deduction. Well, that's going to save me the $22 in tax. I mean, that's good. I'm not ever going to turn away free money, right? So if somebody wants to give me money, I will take it. However, a $100 tax credit means I pay $100 less in taxes. So a deduction in this case would be worth $22, credit $100. you can imagine which one most people prefer, right? So I say this as context for the next slide, as well as some of the things we're going to talk about when we start talking about what happens in 2026, because we're going to see some credits changing. And the first credit I want to talk about, and I'm going to build up to it a little bit because this is something I want to make sure that you do have some background on, and that's the child tax credit, affectionately known as the CTC. And this is a credit that reduces your tax liability for families with qualifying children to help offset the cost of raising children. Qualifying children, there's a whole work form that you have to fill out on who a qualifying children is or child is. Many times, the children in your life who are younger children will qualify. This can be what they call partially refundable or non-refundable. So what that means is, and this is another important concept, is when you have a refundable tax credit, that means if you no longer owe taxes, it'll still pay you. So let's go back to that example before. Got a $100 tax credit. My tax bill is only $50. Well, the government will say, well, we're going to pay the $50 and we're going to give you 50 more because your tax credit would take you past what you had to pay. A non-refundable is limited by your tax. So in other words, if we take that same example, even though I got a $100 tax credit, I would only be able to really benefit from the $50 in taxes I was going to pay. Again, not bad, right? We're going to take it if it's offered, but it would be great to get the additional money back. Qualifying child must meet age, relationship, residency, and support tests. Like I said, there's a whole form that your tax preparer, if you're doing it online, that you have to go through to show that they are a qualifying child. Do know most of the time, if it's a child who's with you the majority of the year, and it is, your child by birth or adoption, chances are they're a qualifying child. When you start getting past those things, that's where it gets murkier. This credit does phase out with higher incomes. The maximum credit right now is $2,000 per qualifying child under age 17, so 16 or younger. The refundable portion is up to $1,700 per child, and that's going to be indexed for inflation. Phase out begins if you're making more than $200,000 and you're single, $400,000 if you're married filing jointly. You also get an additional credit of $500 for other dependents. So those could be other people in your life who are dependent on you. Like, let's say you have a nephew or a niece who is staying with you for a period of time. So what's happening with the HR1 is we're moving from $2,000 to $2,100 per child. And that's for ages 0 to 5, right? We're not seeing changes in the other age ranges. We're also seeing a higher level of refundability, but the earnings threshold is coming down a bit. So in other words, when you start to lose the credit, it goes down, but still, again, good deal. So, if we take a couple of examples just to see how it can play out, let's take Johnson family. This is a single parent. The adjusted gross income, so their income after their initial deductions, is $25,000. They have 3 kids. Their liability is $500. In this case, right, we're seeing that they would be eligible for up to $6,100 in credits. They have a 2-year-old, $2,100, then we get the 6-year-old, the 10-year-old, all adding up to $6,100. When we calculate the refundable portion of it, and you'll see there are some calculations there in case you want to go through that. The amount that is refundable is $3,375, right? So that's the lesser amount of those two numbers. And again, I'm showing you this for purposes of transparency. Again, you will not be quizzed on any of these things. In this case, right, the person has tax liability, $500. they reduce their tax to zero, and they're still also getting money back because of the refundability. So that's a good deal in that case, right? She's getting some money back because of that ability to get that tax refunded to her. We're also going to see some deduction increases. And we're going to see the standard deduction, and that's the typical deduction that individuals take, which is considered to reflect the basic kind of costs of living, if you will. I know we may disagree with this number. That's what the IRS tells us. So that's what we go with. And what we're going to see is that, whoops, that, sorry about that. That deduction go up from $14,600 up to $15,750. If you're married filing jointly, you're going up. Head of household is going up. So those are good things. That means that if you take that standard deduction, it's going to decrease even more of your tax liability. We're also going to see a senior bonus. Now, this kicks in if you're age 65 or older, and this is an additional $6,000 deduction per taxpayer. And this, by the way, is even if you itemize, right? So with the standard deduction, you get two choices. You either typically, not typically, legally, you have to either take the standard deduction or you have to itemize and list everything. With the bonus, senior bonus deduction, even if you decide to itemize to, let's say you've decided either on your own using software or with your tax preparer that it's going to make more sense for you to itemize, you can still take this. And that's very unusual in tax law. And in this case, it's another $6,000. So again, it's not a $6,000 credit, $6,000 deduction, right? And this is something that does phase out. So again, if we think about that adjusted gross income, that after those initial deductions, if you're a single filer making 75,000 or more, or married filing jointly and you're making 150,000 or more, it's going to start going down. That's 6,000, and at higher incomes, it goes to zero. So that is something to keep an eye on. If you do have, you're making more money. And here's a couple of examples of how it plays out. In example one, let's say we have both spouses, age 68, they're married filing jointly, their AGI is 85,000. They take the standard deduction. They now get the senior bonus for both of them. So that's going to be a total deduction of $43,500 off their taxes. And again, not a credited deduction, but that's really pretty good, right? Now, again, if we think about a higher income senior filer, right? Age 70, AGI is 95,000, standard deduction is 15,000. They're going to experience a partial phase out. So really, they're only going to get 4,000 of that 6,000. So again, as you start to make more money, this is going to be less lucrative. It's not just one standard deduction, if you will, where you just get it. It is something that does go down as you get older. As you make more money as you get older. Misinformation. Another deduction that we want to talk about is tips, and specifically childcare educators are listed as one of the professions where tip deductions are allowed. So what does this mean? Generally, the tip deduction that we're talking about that's in HR1 is going to exempt tip income from federal tax. However, it's still going to be subject to Social Security, Medicare taxes, FICA. So in other words, if you have $1,000 that you've gotten in tips, right? Well, I'll give you an example in a minute. It's right on the screen. But in this case, if you get that money, well, let's just go through the example easier. I don't know why I'm trying to wing it. So let's say you're an educator, you're earning $31,200 annually. You get $800 in tips. What will happen is in this case, let's say you're in the 12% tax bracket, it's going to save you about $96. The challenge is You also have to make sure that you're paying Social Security and Medicare on those tips. That's going to be $61. So what ends up happening is you have a net benefit of $35. So again, in this scenario, she saved $35. Again, we're not going to turn away deductions if we can get them, but also I want to make sure that that's transparent. That in this case, again, the deduction may not be as big as you may. And Cindy is asking, are the tips the bonuses such as Christmas gifts? It depends on whether they're giving you cash or a gift and the size of it. Um, what we would really want to focus on here is if they're giving you any sort of cash, whether that is cash in hand, a check, Venmo, any sort of app payment. Those are the things that you'd want to think about, Cindy. Did that answer the question? What wouldn't be cash? Well, let's say they went out and they bought you something, right? Like they bought you a ceramic elephant, or they bought you something that they felt you could use, or correct, that wouldn't be a gift, right? Or tip, excuse me. Give me the money. I would tend to take money too over the ceramic elephant or other things as well. Um, so with that, why don't we transition to 2026? And as I mentioned, a lot happens in 2026, and we've already seen some things that are going on, but we're now going to see some other changes. And one of those is to the child and dependent care tax credit. Now, this is, again, I'm going to give you a little background because it's worth going into. This helps families offset the cost of childcare for children under 13 years old. So this is so that parents can work very explicitly. And it is for children under 13 because it also does cover, summer programs and such that you may have your child in. This is based on a percentage of eligible expenses, and there's a cap: 3,000 for one child, 6,000 for two or more children. It is a non-refundable credit. We learned that before, right? That means that if it goes past your tax liability, you're not getting anything back. So what happens to the CDCTC? Say that 5 times fast. One, the maximum rate is going to go up for the lowest income families. So those with an adjusted gross income of 15,000 or less. The minimum rate is going to stay the same when you go above that level. So if you're making less than that, it becomes something that's going to help you more. If you're making more than that, it's going to stay the same. And there's an income phase down, just like we've been talking about. As you earn more money, you can no longer take it. So if we look at some of the specifics, whoops, I don't know why my mouse has decided that it's like gonna be so happy to change the slides. Let's say you're married filing jointly, right? It starts to drop after that 15,000 through 150,000. It starts to go down. If you're above 206,000 AGI, it's flat 20%. Single filers, you start to see a similar decline, and it goes flat to 20% after 103,000 AGI. The caps on the expenses stay the same. So it's 3,000 for one dependent, 6,000 for two or more. The main impact is going to be for those lower middle income families who are going to be getting a higher percentage. So let's look at what this looks like. We have two families. We have Martinez family married filing jointly. They have an AGI of 15,000. They have childcare expenses 6,000 for both their kids, right? Under the old rules, they'd be looking at $2,100 that they would get out of the credit. Under the new rules, they're getting another $900, which is great. So this is a case where there's a big gain. Now, if we take Mi Chen, who's a single parent, she has $15,000. Her childcare expenses are $3,000. She has one child. Her income tax liability is $500, right? In this case, because it's non-refundable, she doesn't see a difference, right? Even though she could get a higher level of credit, she's limited to that $500. So that's the challenge with the non-refundable tax credit is even though she could have gone higher up to 1,500 that she could have benefited from the credit. In this case, she's only going to see the same amount, which is her tax liability of $500. So, that is one tax credit that, again, you want to navigate carefully. Another tax credit, and this is one for businesses. So, this is one that I want you to be aware of because if you're a childcare business owner, if you advise childcare businesses, this is likely something you're going to start hearing about, which is the employer provided child care tax credit. Um, or affectionately, it's known as 45F, which is the section of the tax code it falls into, right? And this is a little used tax credit. But the idea of it's that it's supposed to promote businesses for investing more in childcare for their employees. So the hope is it was going to boost the amount of money that businesses were putting into the childcare industry. In the past, it's been fairly low, very not heavily used. Um, in this case, what we're going to see is that the credit is going to increase up to 50% of what small businesses spend and 40% for other businesses. The annual cap, the amount is going to go up from 350, which is where it was, to 600,000 a year for small businesses, 500,000 for other businesses. The challenge with this credit, one of the challenges has been that you have to have either on-site childcare that you're paying for or a contract with a childcare provider. And I say it's only a challenge, not because it's hard to get a contract with a childcare provider, but for business owners, it's often hard to navigate that. One of the other changes they've made is what they call an intermediary model. So now organizations, like let's say for the sake of argument, like a CCR&R or another organization that works with childcare and also works with businesses, can be the contract holder. So in other words, the CCR&R could have contracts with multiple providers, agreements with businesses. The businesses would be able to access the credit, provides more money flowing into the system that goes to the childcare providers. So again, this is not something that is unfortunately going to hit you directly, but it is something that we are hoping will promote greater investment by businesses. We have two questions. So centers could use to give you actually can't. So the way it works for if you are a child care provider, 45F, is you have to have 30% or more of the kids in your care being employees' children. So Ashley, let's say for the sake of argument, because it's later in the evening, it's been a long day, you have 100 kids let's say you have a center and you have 100 kids. Hopefully you would never have 100 kids in your home for a variety of reasons. So you have 100 kids, and let's say 30 of them are employees' children who you're either providing a discount of 0, 100%, but they're employees' kids who are in the care of the center. You would then be able to tap into this credit. Unfortunately, the way they've designed it is it doesn't just reward discounts for childcare, and I wish it did. But you would have to hit that 30% or greater. And I've actually only seen it twice now. It actually came up last week with a family care provider, believe it or not. But prior to that, I had only seen it during the pandemic when people were providing incentives for the staff to have their children in care so they'd return to work. But at the same time, enrollment hadn't gone up. But we are seeing this as a potential boost to the ecosystem. So as people talk about it, we want you to be aware of it. So let's talk about another change that we're seeing. As I mentioned, 1099s. 1099 NEC miscellaneous is kind of a catch-all, right? Many of you will see this if you were on the food program, the child and adult care food program. You will receive one of these from the organization who is providing you with funding at the end of the year. This is also something if you have a contractor that you're providing to your contractor, a 1099. The threshold has traditionally, for many years, been, I should say traditionally, it's been for many years $600. It's now going to go up in 2026 to $2,000. So what that means is, and it's going to be indexed from inflation from there. So as inflation goes up, that number will go up. So what does that mean? If let's say you have a contractor who makes $1,000, like let's say you have a substitute who is a true contractor, makes $1,000, you don't have to issue them a 1099 NEC. And I'm seeing a typo there where it says 1099K at the end. That should be NEC. So you wouldn't have to issue them one. They still need to report the income. You can still deduct the income even if you don't issue a 1099. What it does is it reduces that paperwork burden for you. That's all it does. But, for some childcare providers, it can be a bit of a burden. And so, we've heard over the years that they were hoping that this would go up, and it has. Another change that we're going to see are the child investment savings plans, which have been affectionately called the Trump accounts. This is a savings program. It's a tax deferred investment, right? Which means you don't pay taxes on it until you take it out. So you put the money in now, you don't pay taxes on the money. You take it out, like when you withdraw the money, you then pay taxes on it. It's going to be available for children under 18. It's going to be automatically invested in a U.S. stock income fund, index fund, excuse me, which, without going too much in the details, like if we were having a conversation on retirement, I generally like index funds. They tend to outperform the market statistically and have for decades. So that's not a bad investment. And it converts to a traditional IRA at age 18. So if it isn't used by age 18, it can become a traditional IRA. The federal government is going to provide a one-time $1,000 deposit into it. And so if you take that $1,000 deposit, and let's say you don't touch it for your child, again, we're thinking, pretty conservative index fund. By the time they're 18, if let's say they do want to pursue college, that would be $4,000 to $8,000, depending on how the market does. By the time they're 65, you'd be looking at $235,000. So if they just take that $1,000 and they don't touch it for their entire life until they retire, it's not bad. This is going to be for U.S. citizens born between January 1st, 2025 and December 31st, 2028. So when we look at this opportunity, I mean, certainly the free $1,000 is a nice deal, but it also allows families to put in money up to $5,000 a year post-tax, which means you don't get a tax deduction now. Employers can actually use this as a benefit and put money in tax-free. Nonprofits, charities can contribute as well. So if you have a nonprofit or a charity, let's say who wants to support childcare providers in a certain area and help their children, they could theoretically provide gifts into those. And the total for any of those gifts cannot exceed $5,000. So if Nancy puts in $3,000 for her child and her employer wants to put in $2,500, she could only accept $2,000. Now, of course, she could change the amount that she's going to put in, but it can't go more than $5,000. Before 18, there's no withdrawals. After 18, it's taxed as what they call ordinary income. So whatever their marginal tax rate is, they're going to have to pay that. There is a penalty if it's withdrawn before age 59 and a half, because the idea is that you're holding on to it. The exceptions, just like many retirement accounts, the exceptions are college expenses and your first home up to $10,000. So Unlike 529 plans, which are educational savings accounts or Roth IRAs, these withdrawals are going to be taxable. So this may be a little less advantageous if you're thinking about this as a college savings program. Now, again, would never turn away $3,000, right? The government wants to put $1,000 in the account for your child, take it. But as you think about how you might build up the college savings or lifetime savings for your child, there are other vehicles you may want to consider that overall are going to provide a greater benefit. A little bit off of the track in some ways, because I know we've been talking a lot about direct taxes for business owners or families. I do want to talk about some of the immigration related impacts because these are something we're seeing hit educators, hit business owners, and hit families, and we want to make sure that you know what's coming. One is there's going to be a remittance tax. So this is for individuals who are not citizens or permanent or have lawful permanent residence. They are going to have that 1% tax on any money that they send, that they transfer out of the US. So, for example, that's going to mean $300 additional taxes on someone who's sending $30,000 to family abroad. So just know that that's going to be an extra tax on those remittances that they may be sending back to their home country. We're also going to see increased immigration fees. Work permit fees are increasing. Family-based visas are increasing. New asylum application fees are increasing. And again, I don't say that, we can get into a political debate about immigration. This is beyond that. This is just about dollars and cents of the families that you serve, the employees you may have, and your own personal status as a family. We're also going to see the educational tax credits restricted. So American Opportunity Credit, Lifetime Learning Credit, which are, now you know what tax credits are and how valuable they are. These are ones for pursuing higher and postgraduate education, as well as some job education. This is going to require a Social Security number. So if you have an ITIN, you will no longer be eligible for these programs, which means DACA recipients and other people who are lawfully present in the US may be losing up to about $2,500 towards their education a year. We're also going to see Medicaid eliminated for humanitarian asylum applicants, even if they're, in the US, as they're pending their case. So the months that it takes Medicaid to review your application form, you will no longer be eligible to be on Medicaid, even if later you're found to have been properly eligible. SNAP, again, there's going to be a 5-year waiting period extended to additional immigration categories. So that's going to be going to be extended. What we're looking at bottom line from these changes is that probably a $3,000 to $5,000 impact on families, especially those with mixed status, where one is a lawful US citizen, one may be undocumented or have a different status. So just be aware of that as you navigate it with your families, with your employees, that likely these costs are going to go up in 2026. We're also going to see some student loan changes. So the current rules are that you can deduct up to $2,500 in student loan interest. There is a phase out as you make more money. And these are available for qualified educational loans. In 2026, this is going away. And there's no grandfather clause for existing loans. So if you have a bunch of student loan debt and you've been taking advantage of this deduction, or not a whole lot of student loan debt, and you've been taking advantage of this deduction, it is going away in 2026, unfortunately. What it means is if you take a look at, let's say you went for your bachelor's, you graduated, you had $50,000 in loans, your annual interest 6% is roughly $3,000 a year. This means that it's going to be taking $3,600 annually out of your pocket. You're not going to get that back. So again, not a huge impact in and of itself, but as we're seeing, there's a lot of small ways where families are going to have to pay some things. We're also going to see in 2026 Medicaid changes. The work requirements, and again, I had mentioned to you earlier that we were going to talk about where there are rules that are going to come up. This is a place where we don't know any of the rules around work requirements. Everything I have on this slide is pretty much all that's in the bill. So a lot of the specifics about what might be volunteer work, how are they going to handle self-employment, right? If you are a childcare provider in your home, and you are a sole proprietorship, how are you going to be affected? Well, how will they track work? We don't exactly know. If we look at other programs, there are analogies, and there's going to be some additional paperwork, especially if you're a sole proprietorship who's on Medicaid. But we don't know for sure what the rules are right now. And what we do know is if you're between 19 and 64, you're going to have to work or volunteer 80 hours monthly at a minimum. The exemptions are going to be pregnant women, caregivers of young children, the disabled, students. They're going to give you 3 months to find employment. The states are going to have these verification systems. And again, we're waiting for the Fed to give us some more rules. And then those are going to go down to the states, which will then go down to you. So just know that these changes are going to hit. And even if you say, well, gosh, I'm gainfully employed, I have my own childcare business at home, the question will be, what's the paperwork going to be for you? And we just don't know. And I'm not trying to scare you or anything. It's a big black hole right now. We're going to see some eligibility restrictions. There's going to be an asset test. So $2,000 for individuals, $3,000 for a couple. They're going to look back for 5 years to see if you've transferred assets out. And if you have if you are not a US citizen, there's going to be extended waiting periods to get on Medicaid, as we talked about earlier. The other thing to be aware of is that the paperwork is going to change. So continuous eligibility, as they call it, right? How long you continue to be eligible without having to go through all the verification paperwork. For children, that's going to go from 12 months to 6 months. For adults, quarterly. And we're going to increase, and again, we're waiting for the rules on this one. So I don't know how bad it's going to be, but we are going to increase documentation requirements on Medicaid. I don't know about many of you. I have been through the Medicaid process for a family member many times, or had when she was still alive. It is a tough process. I was doing it in 2 different states where they had lived at 2 different times. It wasn't like they were getting Medicaid in both states. Um, and, probably over the course of, gosh, over 10 years. And just that annual renewal, I never hit the paperwork once. And I think I'm pretty good with paperwork, never hit it right the first time once. And so what we are going to see is now, as bad as it was annually, if you have kids, it's going to be twice a year. If you're an adult, it's going to be 4 times a year. So again, are we seeing per se cut here? No. We're likely to see some families drop out of the system because they can't keep up with the paperwork. And again, just saying, not getting political or anything, just saying this is a reality of this equation. So, if we think about some of these scenarios and how it might impact, a low income worker who's working part-time, will likely have to increase the amount of hours a month or lose coverage, right? And so if they're taking care of a child, somebody with a disability, this could be very difficult. So they're going to need to find that second job potentially, or a volunteer position. Families with modest savings, let's say you have $5,000, well, you're going to have to spend down that money before you're eligible. And so that means that your emergency funds have gone down that much more. The Congressional Budget Office is projecting that cumulatively in 2026, we're looking at 1.5 to 2.3 million people losing coverage in that first year. And this is, again, going to be primarily people who are able-bodied adults, if you will, but we are going to see families with children being affected by this as well. And again, just saying this to know that as you navigate this with your families, with your own family, with your educators' families, this is what we're going to be seeing. 2027, we're going to be seeing some changes to SNAP as well. The Supplemental Nutrition Assistance Program, formerly known as food stamps. This is a federal food program, provides benefits via an EBT card, electronic transfer card. It is the largest anti-hunger program in the US, and it's serving about 42 million Americans monthly. So that's a pretty good percentage of families that are taking advantage of it. Average benefits per person, $195, family of three, $577. Maximum benefit is $766. Right now, this is the current eligibility, right? Your gross income has got to be equal to or less than 100% the federal poverty level, right? You've got to have a net income of less than or equal 100% of the federal poverty level after deductions, right? You've got to keep those assets low, and you are required to work. What we're now seeing is in 2027, or will see, excuse me, is expanded work requirements. So we're going to see more people having to work to stay on the program. You're going to see people 18 to 59 having to, without dependents, having to participate at a greater level. Very similar to what we were just talking about with Medicaid. And so we're also going to see some changes around, how much are you going to be able to work and train? How much, if you have your own issues that you're dealing with, how much of that time can you take to work with those health or other issues versus how much time you have to spend working? What, again, the Congressional Budget Office is estimating is about 750,000 additional adults are going to be subject to these requirements. The stricter limits, again, the new limit is pulling those assets down. So what that means is instead of being able to have 2,750 in that savings account, families will only be allowed 2,000 or less. Vehicles are going to count as this. Previously, many states exempted them. But if there's a vehicle in the home that's worth 4,650 or more, that's going to count against these limits. So and also are going to start counting retirement and other accounts. So, when we look at some of these changes, right, here's some more details on what we're seeing, categorical eligibility changes. You used to be eligible if you were automatically from being on TANF or Social Security, but now you have to independently meet those requirements, right? So what we're seeing is, again, another area where we're looking at attrition through paperwork, right? Which is another 1.8 million losing their eligibility potentially. So if we take a few examples, we have Luz, age 52, retail worker, right? She's working 24 hours a week, $12 an hour, $1,300 a month, right? She would have to increase her hours or potentially lose benefits. If, let's say, she's working for a childcare, a family care provider, right, who may have a limited amount of time that they could give her, this means that she may now need to balance two jobs in order to keep working with you and for you. The Hung family, two parents, two kids. In this case, they've been able to put some money in that emergency fund, right? They're going to have to spend down that money to qualify. So they're going to have to spend $1,500 out of their own pocket, out of that emergency savings, just to qualify. So again, they're going to be stuck choosing between that emergency savings or food assistance. Finally, we have Robert, age 68, Social Security recipient. In this case, he owns a 2008 Honda Civic. It's got a value of $6,000. In this case, because of the car value, he's either going to have to sell that reliable car that he may have or forgo food aid. And so again, just saying that we're creating in 2027 some trade-offs for families. And this includes childcare business owners, their educators, on what they're willing to give up to continue those food benefits. So I want to talk about a few resources, then I'm going to open us up for questions. One key resource is the Tom Copeland blog. Many of you may be familiar with Tom. He was great in the industry for family care providers. About 3 years ago, he retired. He bequeathed that blog to us. We continue to maintain it, to add to it. There's also a place where you can ask questions free of charge, and we will answer them. So if you do have questions that come from this or other things around your business, um, do know that that's an option. We also have a YouTube channel with over 600 videos. These are all free, the resources I'm telling you about, on a variety of topics. Everything is in English and Spanish. We're constantly updating these as well. We also do Ask the Expert videos. So many times we get those questions coming in from Tom. We will do a video from Tom's site. We'll do a video explaining the answers. If you're in Texas and a family care provider, we have been lucky to be entrusted by the state to work on their family child care network. And as part of that, there's a number of services, everything from childcare business coaching in groups, one-on-one. There's going to be startup mini grants available, networking opportunities, and also shared services to reduce your costs. And again, this is for Texas providers, but a good opportunity if you're in Texas. Similarly, if you are in Georgia, we also run the business coaching there for the state of Georgia. Not the same sort of level. We do coaching. There are guides, there are videos on the Decal Thriving Business Academy, but know that that is another source of support. So at this point, I'm going to take down those slides, open up. If you have questions, don't hesitate. If you feel more comfortable putting them in the chat, put them in the chat. If you feel more comfortable asking them, don't hesitate to just come off mute and ask.
Hi.
Hi, Sue.
I have a question in regards to the snippet slide that you showed us about tips. You didn't talk about it at all. Can you go back to that?
The tip slide?
Yes, you didn't
Sure.
show it to us. You went right over it.
The example? I thought I went into it.
You did not go into tips at all.
Um, oops, here we go. It's back here, deductions. So when we talked about deductions, this was where I had mentioned, this was the example that I'd actually gone through. So what's going to happen with tips is that they're going to be exempt from federal income tax.
You show
Am
us
I
that?
sharing this? I am not sharing this, am I?
Nope.
Let me share this. So they're going to be exempt from federal income tax, right? So if you are reporting them as you should, in the case, let's say you're an educator earning 31,200 annually, you're getting $800 in tips. You're going to save at the 12% tax bracket about $96. However, they're still going to be subject to Social Security and Medicare taxes, FICA. So what that means is in this case, she's paying $61 in those taxes. So that gives her a net benefit of $35. So in this case, yes, um, you know, she is saving on that income tax, but there's also she's still paying that payroll tax on it, which is going to just decrease it. And by the way, these are just federal taxes, so it doesn't cover the state level.
Sorry,
There
Dave.
was also a question that came up about like what qualifies as a tip. Really, what we're talking about here is, um, is that it is typically money that they're getting versus it is, let's say if you get a physical gift or a box of chocolates, um, you know, those sorts of things, the government would be called de minimis, which means that it's of minimal value. So you're not going to be reporting or worrying about those.
Sorry, Gary. It was about overtime. I made a mistake. It wasn't tips. It was overtime. You showed us a slide on overtime.
Oh, the overtime I missed. Oh, I'm sorry.
There you go.
There, you got me, Sue. I did
I
miss
did.
that one. My apology. I was sure I talked about tips. So overtime, again, a similar situation, right, with um, the situation with taxes, right? So overtime wages are going to be wages that are worked over 40 hours a week and are, and they're going to become exempt from federal taxes. They're still going to get payroll taxes, just like we were talking about tips with tips. So this applies to any hourly workers who'd be normally eligible for overtime from the Fair Labor Standards Act, right? So if we take an example, you have an educator working 20 for $20 an hour, works 50 hours a week. That money, that overtime pay, that $300 is going to be exempt from income tax. However, it's still going to get payroll taxes. So I think there's been a bit of confusion around overtime pay and tip pay, that it is entirely tax free. You're still getting payroll taxes on it. You're just not getting income tax. How's that, Sue? Did I get it? I got it right. Yes.
Perfect. Thank you.
Excellent. Thank you. And thanks for holding me accountable. I don't know what's up with my mouse today that it's going so quickly. Other questions?
There are some questions in the chat.
Yeah, I'm just taking a look at those. Um, update regarding CACFP. I do not know of any update regarding CACFP. Not exempt from state unless state doesn't tax tips. Is that correct? That is absolutely correct. That goes back to what I was just saying. See, Cindy got ahead of me on it. I know she had messaged privately. She had to drop off, unfortunately. Um, so in the case of tips, of um, overtime pay, we're talking about the federal impacts on that pay, but not the state impacts. State can still tax you on that income if they so choose, and I'm not hearing about any states who are exempting it right now. You may know of some. I do not. So that is the case. And childcare owners who work 60 hours, can 20 hours be overtime? Jessica, no. When we talk about the Fair Labor Standards Act, owners are not considered to be subject to it, unfortunately. Trust me, I thought about that when I first saw that it was in the bill when it was in draft and looked very closely at it, and they were keeping it to employees who fit that criteria, unfortunately. Other questions? Dan, I'm happy to. And I should say also, Cindy did mention she isn't always a she in the provider world. Cindy is 100% correct. So my apologies if I offended anyone. I tend to be differential because we are in a world that often thinks of men before women, and childcare is a world that is predominated by women, and that's a wonderful thing. So I hope that didn't offend anyone. Any other questions? Going once, going twice. If you do have questions, don't hesitate to reach out to us through Tom's page. We're happy to answer them. Um, I, hope all goes well. I hope this was helpful, and do look forward. We're hoping to do more of these free webinars in the future to help keep you up to date on what is changing. Oh, Sue, unfortunately, we cannot issue certificates for it. Thank you, Melinda. Excellent. Everyone take care and have a good night.